Welcome to today's explainer. Look, if you're trying to figure out where to actually put your money, but you keep hitting this massive wall of financial jargon, the kind that makes you want to just close the app and go buy an iced coffee instead, well, you are in the exact right place. We're tackling the ultimate beginner's dilemma today. You know you want to grow your wealth, but the second you open an investing app, you're hit with a mountain of options and confusing acronyms. It can be totally paralyzing. But don't worry, we're going to clear that right up using a highly structured, direct approach. ETF or stocks? Which one should you actually start with? It's a completely valid question to be stuck on. And honestly, if you're feeling stressed about making this choice, I want to validate that right now. Choosing the wrong path for your specific personality and goals can make investing feel significantly harder and way more stressful than it needs to be. It's literally the hurdle that stops so many people before they even run the race. Because let's face it, without a clear roadmap, most beginners usually fall into one of two very common traps. On one hand, people start picking random stocks based on, whatever's trending on social media, which is a fantastic way to lose your money really quickly. Or, on the other hand, they get so intimidated by the complexity of the whole thing that they do absolutely nothing. They just sit in cash and let inflation slowly eat away at their savings. Obviously, both are traps we want to avoid. And that brings us to our golden rule for this explainer. Clarity beats complexity. You absolutely do not need a finance degree to make smart money moves, I promise. I'm going to break down the differences between ETFs and stocks in the absolute simplest, most direct way possible. By the end of this, you're going to have the exact visual clarity you need to decide what fits your personal financial goals. All right, Section 1, Unpacking the ETF, the basket strategy. So an ETF technically stands for Exchange Traded Fund, but honestly, just forget the acronym for a second. Let's just think of it as a basket filled with multiple companies. Instead of trying to pick the one winning horse in a race, you're essentially buying a piece of the whole track. By purchasing just one single share of an ETF, you are instantly investing in many different places at the exact same time.
And the direct result of that basket approach? Built-in diversification. Think about it. If one company in your basket has a terrible quarter, it's totally okay because you have dozens or even hundreds of other companies in there balancing it out. That ultimately means significantly less risk compared to betting all your money on just one single stock. It's like having an automatic safety net.
Moving on to Section 2, Understanding individual stocks, the single company. Now, with a stock, you're investing in one specific company, period. You are tying your money directly to their performance. It's a one-to-one relationship. If that specific company innovates, sells a ton of products, and just explodes in growth, you benefit directly from that success. But, and this is a really big but, if that company makes a massive mistake or their sales drop, your investment drops right along with it. There is no basket of other companies there to catch you. And that brings us to a really critical trade-off. With a single company strategy, you are taking on higher risk. There's just no denying that. However, mathematically speaking, that higher risk is tied to a higher potential upside. Right? Like, if you manage to pick the next massive tech giant right before they take off, a single stock is going to grow so much faster than a broadly diversified ETF. You are basically trading safety from maximum potential growth. Section 3, the risk versus reward showdown. Take a look at this. On the left side here, bathed in that stable green light, we have the ETF side. You can see the diversified lower risk label hovering right above a whole collection of massive corporate logos: Apple, Microsoft, Amazon, Google, Meta, Tesla, Nvidia, Visa, all moving up together on a nice, steady trend line. But then, contrast that with the intense, volatile side on the right. That's the stock side. It's labeled higher risk, higher reward. Notice how there is just one huge Apple logo over there, backed by a much more jagged red graph line. It perfectly captures that big question at the bottom. Which is better? To really distill the core philosophical difference here, ETFs are fundamentally about spreading your risk to create stability, while individual stocks are all about making a highly focused investment to achieve precision. You have to ask yourself, do you want to just capture the general upward movement of the economy, or do you want to precisely target one company's explosive growth? So which is better? Well, the reality is, it entirely depends on your destination. There's no universal wrong answer, only what's wrong for you. That being said, for beginners who are just getting their feet wet, a lot of folks start with ETFs because they offer that essential balance and simplicity. It lets you get in the game safely. But interestingly enough, many of those same people might choose to add individual stocks later on, once they actually understand how the market moves and breathes. Section 4, your first investing strategy. All right, I want to relieve some of the pressure you might be feeling right now. You do not have to choose just one path forever. Here's a highly actionable, structured approach for beginners in 3 easy steps. Step 1, start with ETFs. Use that basket approach to build a safe, diversified foundation for your portfolio. Step 2, slowly learn stocks. Once your foundation is rock solid, take a small amount of money and practice picking individual companies you actually believe in. And step 3, keep it simple. You can absolutely combine both strategies, enjoying the safety of the ETF while learning the precision of the stock market at your own comfortable pace.
Really let this golden rule sink in. Start simple, learn as you go, and stay consistent. This prevents you from overthinking it. You don't need some incredibly complex strategy on day one. You just need a simple strategy that you can actually stick to month after month. Because consistency, that will always beat complexity in the long run.
Now, before we wrap up, a really quick but vital safety line for you. The structured breakdown we've gone through in this explainer today is strictly for educational purposes only. It's not financial advice tailored to your specific bank account. Please, always do your own research or consult with a professional before making any final investment decisions.
So I'll leave you with this. Which will be your first investment? Are you going to grab the diversified safety of an ETF basket? Or are you going to take a focused swing at a single stock? Whatever you decide, the absolute most important step you can possibly take is simply starting. Don't let the jargon hold you back any longer. How are you going to get your money working for you today?